Hi, we're talking about Your Money Matters on NDTV Profit because we understand that your money matters. My name is Alex Matthew, and today I'd like to talk to you about booking losses. I know you've probably heard that it's a bad idea to convert notional losses into actual losses when it comes to your equity portfolio, but we're here to tell you that that might actually not be a bad idea because you'll be able to set off the tax that you might have to pay on capital gains even years from now. Joining me to talk about this is Arvind Rao, who is the founder of Arvind Rao Associates. Arvind, first question. Is it not always a bad idea to book losses?
Not at all. In fact, as funny as it may sound, but there have been occasions where people have had these impressions that income tax is always payable on profits, and whatever losses that you make or book in equities, that's a separate account. Regardless of the losses, you still have to pay taxes on the profits. But when we tell them that it's not the case like you sounded, but it's actually the net of this on which you have to pay tax. So we've got those aha moments from certain investors as well. So at typical occasions like the point in which we are now, which is almost the year end, and given the kind of fall that we have seen in the markets, I'm sure many portfolios are sitting on losses. So there is a concept which has been more in vogue over the last 2-3 years, what is also called as tax harvesting. So this is a good time when one can make good use, if I can say so, of these losses. So the concept is very simple, that you convert your notional losses into actual losses, and you get to offset these losses against whatever gains, if there are any, that you might have made during the year. And you then pay tax only on that profits. And when we say book losses, it does not mean that you need to get rid out of your position or whatever you were holding. You can always buy that back within a certain time frame and continue holding it as your portfolio component. But by converting the notional into book losses, what it also helps you is to leverage and manage your taxation on the gains for this year in a better way.
Okay, so help me understand a couple of aspects here, because this is not evasion of tax. This is management of tax. It needs to be spelled out very clearly because the law provides for this to take place. Now,
Yes.
I need a few clarifications. Are we talking about short-term capital gain, capital losses, which is less than 1 year of holding, or long-term capital losses? And what is the provision that allows me to set it off against not just this year's gains, but future gains as well?
Okay, fair. So if I understand it right, and Alex, you can correct me if what I'm answering is not helping your query. So let me spell it out this way: is that short-term losses, if there are any, and you book them, can be adjusted only against any short-term gains that you might have made, or short-term losses can even be adjusted against any long-term capital gains that you might have. So short-term works both ways. I'm still talking about losses that you might have incurred during the year. Okay. And if there are any long-term losses that you have in your books, if you book them, those can be adjusted against long-term gains only. So short works with both long and short, whereas long will work only with long-term gains. This is as regards the position of losses for the ones that you incur in the current year. Now, let's say that you do not have any gains in this year, but you still end up booking losses for the current year. So what happens way forward is you are allowed to carry forward these losses for a further period of 8 years. And provided, of course, you file your tax returns within the original due date, which is typically 31st of July. And if you are able to do this, you are able to carry forward your losses. And when you carry them forward, the same rule applies that long-term losses can be adjusted only against future long-term gains, whereas short-term losses can be adjusted against short-term or future long-term capital gains.
Okay. So, clarification. Suppose you book, just as an illustration, suppose you booked 2 lakhs of losses, capital losses, in the month of March, and therefore those are your capital losses from sale of equity, and this is long-term loss. Okay, so you've held this for more than a year. You bought this, say, in January of 2023, so you held it for more than a year. You've sold it in March of 2025, and so as a result of this, you're holding 2 lakhs of capital losses. You carried it forward to the next year, and you've made some capital gains to the extent of 1.25 lakhs. The question is that because the law provides also for an exemption of equity gains of 1.25 lakhs, will you, and maybe you cross it by a little bit, so would you be adjusting for, suppose you make 1.5 lakhs of capital gains and you book it, would you be adjusting 25,000 or would you be adjusting with 1.5 lakhs?
I get the intricacy of your question. So the good news that I would like to break out here is that the exemption threshold is adjusted first. So in this particular example, if the gains are 1.5 lakhs, first 1.25 lakhs are anyways exempt. And against the balance 25,000 of gains is where you have the privilege or advantage to set off the losses that you have brought forward.
Okay, so good, that's clear, very clear. So therefore it's something that you can consider. The other thing that I wanted to ask is, you mentioned a certain time frame. Is there anything in terms of a question that a tax authority might have for you? Why did you sell this and buy it back in 2 days or 3 days time? Is there any such rule?
No such rule that comes to my mind, A. B, well, nothing stops the officer from asking this query. But as long as it is in the usual course of business that you have sold, and later you, as an investor, you probably were more enticed with the future prospects of the particular stock that you had sold, you may always rebuy. So even if to my memory, any precedents that have been there, I have not come across anything of this being questioned. In fact, Alex, let me give you a parallel example. I'm sure you, as well as a lot of our viewers, would have been very much accustomed with this, that whenever a bonus is announced and a share becomes X bonus, the price becomes half, isn't it? If it's a 1:1 bonus. So in that case, when you are selling the original shares, so if I were to give an example, original shares was purchased at 1,000 rupees, X bonus, if it's trading at say 480, and you sell it, you are still able to claim that loss of 520 rupees on the shares, although you know that you have another set of shares which are at zero cost and are still sitting at a profit.
Right.
So no one questions that.
Okay. So and the same rules of first in, first out come into play here in this instance, because therefore you would be selling the first set of shares which you had acquired, and the cost of which drops to 500 or 480.
Right.
A couple of other questions. Since we're on the topic of taxes, let's run through the list of asset classes and talk about the tax treatment here. Real estate, after the changes, how do you treat long-term capital gains?
Nothing, I think, except for the period of holding, which was already, in case of real estate, changed a couple of years back. So any real estate held for less than 2 years is short term, and on which if you sell, you will end up paying a slab rate of tax. And if you are selling it beyond 2 years, it becomes long term, where resident taxpayers have an option to compare the indexed capital gains, the tax on an index capital gains at 20% versus tax at 12.5% on the non-indexed capital gains, and whichever works in their favor, they can opt for it.
Yeah. Okay.
However, for non-resident taxpayers, it continues at 12.5 on non-indexed capital.
Okay. Quick clarification, can you set off your capital losses from equity against capital gains you might make in real estate?
Of course.
You can do that. Okay. So physical gold and digital gold, how do you treat this?
As it pertains to taxes, there is no difference between physical gold and digital gold. So if you are selling them after 2 years, it's again long term. And if you're selling them before 2 years, it's short term.
Okay, and the tax treatment, the tax rate?
Short term again will be slab rates, and long term will be at 20% with index. At 12.5% without index.
Without indexation. Okay. Sovereign gold bonds, though a lot of people are not able to buy this anymore because it's not issued. After 5 years, the lock-in period ends, but if you redeem after that, you effectively have to pay capital gains. If you don't, you have 8 years of holding and you get no capital gains tax, right?
That's correct. So
Okay.
if you hold it to maturity, then there is no tax. But anytime before, it is the same like what we discussed before.
And you do pay tax at slab rate on the interest that you earn, right?
Of course.
Okay. A couple of other questions, right? So you have hybrid mutual fund schemes which are equity oriented and hybrid mutual fund schemes that are not, and so therefore have a less than a certain threshold of equity. 65%, is that right?
Absolutely.
And so you have multi-asset funds also, some of them which fall under this category and that. How do you understand what the tax treatment is?
So hybrid is, you have to look at the fund's portfolio composition. If it is more than 65% of equity, the capital gain taxation will be like that of an equity fund. And if it is less than that, it will be similar to a debt one. One can always refer to the scheme information document, which will highlight what is the composition. Same goes for multi-asset funds. One has to check what is the equity composition in the portfolio. If it is more than 65 equity, then it will be taxed like an equity. Otherwise, it's like a debt.
Okay, the last question, Arvind, and this relates to advance tax. The last window or the last, how do you say, the last pocket or installment of advance tax, the threshold or the date, the deadline is 15th of March. And so tying this to the first conversation that we had with regard to the sale of and loss, capital losses, assuming that you have made capital losses between now and the 15th, to set off any gains that you might have had owing to sale of property or any other capital gains that you might have, including from equity, you don't have to pay advance tax, right?
That's correct.
Okay. And
where I would worry is, since this loss is happening now, there is a possibility that some of our viewers might have already paid advance taxes, the previous installments.
In which case they would have to claim a refund.
Have to file for a refund. Yes.
Okay. And suppose, and I understand that this is not a case that a lot of people will see, but suppose you are someone who has sold a liquid fund or a fixed income mutual fund earlier on in the year, as a result of which you have a certain tax that is due in terms of income that you've earned. It sits on your income and you have to pay slab rate. You would still have to pay advance tax on that. And if you can't set that off against capital gains, right?
Well, liquid funds also qualify as short-term capital gains.
Yes.
So you can set it off against short-term losses that you might have.
Short-term losses, but not. Oh, so okay. But the question I have is, since one is equity and you'd be paying, oh yeah, so it's slab rate. No, it's not slab rate. It's 20%. So how would you set up short-term capital losses in equity against short-term capital gains in liquid funds?
So this is a bit of a gray area, but ideally when it comes to short-term losses, because they are under one bucket of short-term losses, whether debt or equity, and I think they're differentiated mainly on the rates at which they're liable to. So this short-term loss and I will wait to see if there is any correction that comes or a new precedent that comes in relation to this. But I think as of today, you can set off your short-term losses that are taxable at slab rate with the short-term gains that are liable at slab rate with the short-term capital losses on equities, and whatever remains is on that is where you have to apply the applicable rate.
Fantastic. Okay, so clarification at the end, of course, consult your tax advisor when you are in fact taking these decisions. This is just to give you a better understanding of how to manage your finances. Arvind, thanks as always for taking the time, and pleasure speaking with you.